Welcome back to R2 and Traders Nation. My pleasure to have with us here today Jonathan Clements, co-authored the little book of Main Street Money, 21 Simple Truths that help you real people make real money. All right, Jonathan, welcome to Traders Nation. How are you today?
Fine. Thanks for having me on the show, Kurt.
Good. I think you've been with us, too, before. Anyways, Jonathan, you once famously noted that there are only 7 real stories in personal finance. Share one with us.
Actually, my claim is there are only basically 20 personal finance stories, which means that in my course of 13 years as the Wall Street Journal's personal finance columnist, I wrote each of those 20 stories 50 times each. Okay. That's when I knew it was time to quit.
Okay. All right. In today's investment environment, what's the best way to construct or really reconstruct a portfolio? We've all taken a beating.
Absolutely. And the place to start is not looking around trying to decide what the best investment is. You've really got to sit down and go back to basics. And that means thinking about what it is you're trying to do with your money. And that means thinking about your goals. I mean, you're saving for retirement in 30 years, or you're saving to put your kids through college in 5 years. Clearly, your time horizon is going to drive your asset allocation. Once you settle on your asset allocation, you probably should be looking to globally diversify. I mean, clearly, you look at results this year, there could be great advantages to diversifying abroad. This is a time when I believe people shouldn't be making big bets on just 1 or 2 mutual funds or 1 or 2 stocks. You really should be spreading your bets as widely as possible.
All right. Now, we, as Americans and as really an economy as a whole worldwide, but most particular as Americans, we've learned to put more and more money away. I mean, we're kind of getting to that point where you're forced to. We've got to save for a rainy day. So that does create another problem for us where we have money that's being saved put away, but it's not really doing us any good other than the fact we have it for a rainy day, which doesn't make sense. So where should we be putting that money?
Yeah, one of the things that, one of the silver linings from this current financial crisis is Americans do seem to be rediscovering the virtues of thrift.
Right.
In May, we had the highest savings rate in 15 years.
Yeah.
We hit 6.9%, still not up to that sort of 10 to 15% that a lot of financial planners are talking about, but clearly we're getting into the right area. Yeah. But if you've got that money sitting in a money market fund or a short-term CD, you're not going to be making much interest these days. I mean, look at the yields. I mean, often they're below 1%. So yeah, you think about, if you want high returns, theory says you got to take high risk. So what's high risk these days? Well, clearly the stock market has been bludgeoned.
Yeah.
We got the market, falling, peak to trough 57%. Can't promise that it's going to come roaring back, but if you want to take risks, the stock market looks awfully attractive these days.
Right. All right. So in Chapter 10, you offer up 10 reasons why it's so tough to beat the market. Is it really that tough? I mean, obviously, you've got your peaks and your valleys. You make money going up long. You come down going short as far as the trader's concerned. But what does the average investor do?
The mathematics of investing are brutally simple. Before investment costs, we will collectively match the market averages. After costs, we're going to lag behind. In fact, we're going to lag behind by the extent of our collective investment costs. So what should you do? Well, for the typical investor, I think it's a pretty simple choice. Rather than trying to outguess the market averages and incurring all those high mutual fund expenses and all those trading commissions, you're much better off settling on a diversified portfolio of low-cost index funds or exchange-traded index funds and simply matching the market averages. Right. Sure, you won't have the pleasure of telling your neighbors that you beat the market, but you will do better than most other investors who are incurring far higher investment costs.
All right, so do we do this on our own, or do we keep our finance advisor?
It really comes down to whether you can handle investing emotionally.
Right.
Frankly, I don't think investing is that complicated. You could probably teach a 5th grader the basics of, hey, you need to save, hey, you need to diversify, hey, you got to focus on the long term. But if you're one of those people who can't focus on the long term, you panic when the market goes down, you get overly confident when the market goes up, you can't bring yourself to control your spending, so you save too little, then you probably do need a financial advisor to help you out.
Right. All right. Let's talk about savings once again because, at some point, Americans are rich in many areas, but we're still lagging. You say 6.9% saving rates. Do you see that getting better? Will we become better savers and investors because of everything that we've gone through over the last couple of years?
Boy, Kurt, I wish I could give you the answer to that one. I mean, it's a tough question. mean, you think about, our parents and grandparents' generation.
Yeah.
Why were they such great savers? Well, clearly they were scarred by the Great Depression in the 1930s.
Sure.
They carried that in the back of their minds, and that's why they saved diligently and why they're so averse to taking on debt.
Right.
We had this huge prosperity in the post-war period. People became much more comfortable taking risk. They felt they didn't need to save so much. They felt they could take on a lot of debt. And what did we get? Well, we got the 2007 to 2009 market debacle.
Right.
Will today's current financial crisis bring a return to that sort of depression mentality?
Right.
I guess if I was a betting man, I'd say no. I suspect that once the economy recovers and once the financial markets recover, I think people will probably go back to, saving, 4 or 5%. I don't think we're heading back to 10 to 15, unfortunately.
Right. Do you think, because savings and being leveraged are two different things, do you think that Americans may stay away from being so over-leveraged as we were over the last couple of years? Because I think we'll still save, and I agree with you. I don't think we'll save as much. Once prosperity comes in, people like to spend a little money, like to go out to dinner, have a good time, forget about their woes of the week. And so I think they'll do that, and I think that they'll still save. I don't think it'll be as great. But will we be as leveraged as we were? I think that is the sting out of this whole thing. That's where Americans have been stung. They've been plunged. They plunged themselves into the worst personal economic times that they could imagine because of being over leveraged. Will they be over leveraged when prosperity comes kicking back in?
Well, I think one of the big reasons people ended up being over-leveraged was because of the illusion that real estate never goes down in value. People felt that they could buy a house with 90, 95%, 100% leverage,
right,
and that it was all going to work out okay.
Sure.
I mean, if anything comes out of this market decline, I think people now know for sure that, yes, home prices do not always go up. I mean, we've got real estate prices nationwide down about a third from the 2006 peak.
Right.
A lot of people are underwater. I think people will be much more nervous about taking on the degree of leverage that they have in the past.
Right. All right. So let's talk about paying off our debt. And is paying off our debt is better than a bond investment? And what kind of percentage return can we anticipate in paying off our debt and things of that nature?
Well, it's really pretty simple. I mean, the effective rate of return on paying off debt is the interest rate on that debt. If you've got credit cards that are costing you 17%, the effective rate of return from paying off that debt is 17%. That is probably one of the best investments you can make. In fact, the only investment that I could think of that is likely to have a better rate of return is funding a 401k plan with a company match. I mean, if your company is kicking in, say, 50 or 100 cents for every dollar you contribute,
right,
I mean, that's like an immediate 50 or 100% rate of return, and you should definitely make funding that 401k your top priority. But if you're already fully funding the 401k and getting the total company match, then if you've got credit card debt, that should be the next thing that you're paying down.
I think that's great advice. All right, Jonathan, where can we find a copy of the little book of Main Street Money?
It's available at good bookstores everywhere and a lot of bad ones as well. It's also online, like all the usual places, BarnesandNoble.com, Amazon.com, Borders.com.
All right, absolutely fantastic. And you're still with the Wall Street Journal, are you?
Nope, I left the Journal. I'm now Director of Financial Guidance for City Personal Wealth Management.
Very nice. What's the website, Jonathan?
For the book or for
the website, where you're at? Where can we? Where else can we find you?
Well, you can go to JonathanClements.com.
Perfect.
Or you can go to Citibank.com.
Fantastic. Jonathan Clements, folks, is with us here today, co-author of the little book of Main Street Money, 21 Simple Truths that help real people make real money. Jonathan, thanks for being with us today. Appreciate it.
Hey, thanks for having me on the show.
You're more than welcome. All right, head out today, get a copy. Amazon.com, Barnes & Noble, your favorite bookstore, all the good bookstores, like Jonathan said, and maybe even some of the bad ones, too. Why not? All right, and don't forget, go to the bookstore on the corner, too. That guy on the corner, an independent guy, he's in your community. Support him, too. He needs your business. All right? Head on over to the corner. Wherever you go, just get a copy of the little book of Main Street Money. Great, great tips from Jonathan Clements. Okay? All right? 21 Simple Truths that help real people make real money. There you have it.